Options can look exciting, but they also carry big risks. This video is for education only. It is not financial advice or trading advice. Always do your own research or speak with a licensed professional before making decisions. There are 5 things that can go wrong when you trade options. First, you can lose the whole premium. When you buy an option, you pay a fee called a premium. It's kind of like a down payment to participate in the stock market. But here is the catch. The stock doesn't have to move in your favor for this option to expire worthless. Meaning if the stock ends up anywhere other than where you predicted it would be on the day the option expires, you will lose all the money you paid for the option. And since this happens on the day of expiration, there's no opportunity to recover the losses. The second thing that can go wrong is something called time decay. As time goes by, an option loses value. That's just how it works. It doesn't matter if the stock moves slightly in your favor. If the expiration date is quickly approaching, the option can still lose value because time is running out. Think of it like a countdown timer. The longer you have before the expiration date, the more time the stock has to move in your favor. But as the time ticks away, each second counts. If the stock doesn't make the move you want, the option price drops. Third, there's volatility. When you're buying an option, you're making a bet about how much the stock will move. You might think, hey, this stock is usually pretty active, it makes big moves every day. But sometimes the market can surprise you. If the market becomes calmer than you expected and the stock stops making big moves, the option price can drop even if the stock hasn't changed much. It's like you're at a racetrack betting on a horse. If the horse doesn't win, you lose the bet. But in some cases, the horse might still come in second or third and you'd get some of your money back. With options though, if the stock doesn't move the way you predicted, you often lose everything. The fourth thing that can go wrong is leverage. Options allow you to control many shares of a stock with a small amount of money. For example, let's say you have $1,000 and you use it to buy one contract. That contract might represent 100 shares of stock. So basically with $1,000, you're able to control 100 shares. Now this sounds powerful, right? You can make big moves with a small amount of money. But it also means your losses can happen faster. If the stock starts to move against you, you're losing money on 100 shares for every option contract you have. To make things worse, if the stock keeps dropping, your losses keep piling up. It's like riding a roller coaster. The ups can be really high, but the downs can be really low too. The fifth thing that can go wrong is assignment. If you sell an option, the buyer has the right to exercise their contract and force you to either buy or sell shares of the stock. This happens before the expiration date. For example, let's say you sold an option contract for 100 shares and the buyer decides to exercise their right to force you to sell those shares. This happens even if the stock is still moving in your favor. So you've got 2 choices. Either you fulfill the contract and sell the shares, or you find someone to buy the contract from you. But finding someone to take your place might not be easy. And if you can't find anyone, you'll have to stick with the original deal. So here is the main idea. Options can give you flexibility, but they can also create fast losses. The money you put into an option can disappear quicker than you expect. So if you ever trade options, remember, always protect yourself. Set stop losses. Stay informed about the stock and don't chase after unrealized profits. Don't forget, the world of finance is exciting, but it's important to stay grounded and make smart choices. This has been the channel. If you want to learn more about options trading, we have another video. Thanks for watching. We'll see you next time.